How did promissory notes shape early financial systems? Imagine a world without electronic banking or digital payments. How did people keep track of debts and trade goods across long distances? The answer lies in a simple yet powerful tool called promissory notes. These notes played a big role in shaping how early financial systems worked. They acted like paper money and made trade easier, even before modern banks existed. Promissory notes are written promises to pay a specific amount of money at a certain time. Traders and merchants used them to settle debts without carrying heavy gold or silver coins. This made trade safer and faster because they didn't have to worry about theft or losing valuables during long journeys. These notes were issued by trusted parties like goldsmiths and private bankers who kept deposits of gold and silver. When someone received a promissory note, it was like holding a claim to that gold or silver. They could use the note to buy goods or exchange it for other notes, which created a flexible credit system. The idea of promissory notes is very old. In ancient China, during the Tang and Song dynasties, early forms of paper money called flying cash and jiaoji were used. These notes were issued by the government and printed in official factories, making them some of the first government-backed paper currencies. In medieval Europe, merchants and religious groups like the Knights Templar used promissory notes to trade over long distances. They could deposit money in one place and withdraw it elsewhere, making commerce smoother. In the 17th century in England, goldsmiths began issuing promissory notes after they held deposits of coins. These notes circulated as a form of currency in London and became widely accepted. This was a major step toward modern banking. Over time, these notes evolved into banknotes issued by central banks like the Bank of England. Promissory notes helped early financial systems in many ways. They made trade safer and quicker by reducing the need to carry physical money. They created a transferable, negotiable instrument that increased liquidity in markets. They also led to the development of banks that issued notes backed by gold or silver reserves. These notes were the ancestors of modern paper money and credit instruments used today. Looking at history, promissory notes were a key technological step. They introduced a reliable, transferable, and standardized way to handle credit. They bridged the gap from barter and commodity money to the modern systems of fiat currency. This innovation influenced how banks and financial markets grew, paving the way for today's digital and fintech innovations. Understanding promissory notes helps us see how early financial systems adapted to the expanding needs of trade and capital movement long before electronic money existed.